much for being here, for caring about this subject. And honestly, before we dive into anything that has to do with opportunity zones, thank you for sort of doing what you do for all the communities across the state of Alabama. It is an honor and a pleasure and a privilege to get to work with collectively all the people in this room and people who are doing the kind of work that you're doing to help dramatically impact low-income places, because that's exactly what we do here at Opportunity Alabama, and it's good to see a room full of people that are all kind of like-minded gathered together to talk about the newest in tax incentives for developing low-income places. So, before we get started, quick show of hands. How many of you guys, before you got the invitation to this symposium, had heard of opportunity zones before? Okay. So pretty good, the vast majority of you, and that the answer to that question has changed a lot over the course of last year. Okay, another question. How many of you have tried to labor through the 178 pages of opportunity zone guidance released by the Treasury Department? All right, we got one. Awesome, 2, 3. Okay, so we got a few brave souls. Kendra, you're a lawyer, you don't count. Okay, so this is good. This is good. We've got some explorers here in the room. And that's been kind of, I think, one of the big barriers to utilization of this program, which certainly nationally, but here too, has been just figuring out what the heck it is, what it does, and how it works, right? So my hope is that at the end of today, at minimum, each of you walks away with that working knowledge about how this program is, and what it is, what it can be used for, what it can't be used for, and sort of how we can all leverage it collectively in the room. And I think the reason that that the coalition of CDCs wanted to stagger the presentations as they did was because at the end of the day, the Opportunity Zone tool is, as Kendra suggested, one small tool in your broad toolkit for doing all the things that you do every day. And that people like Ho, who have access to new markets tax credits, historic tax credits, debt financing, right? And all of the other tools in your toolkit, that all of those will play a part in every single one of these projects, right? So, the question is, how does OZs play into that broader capital stack? And that is what we're going to talk about today. So, first things first. You see quotes. I think probably part of the reason that so many of you are interested in this program is because you see quotes like the one up on the screen, pretty consistently in the news, that this is a huge new potential economic development program. The question is why? And the answer is that this incentive taps into a pool of capital that it's not really been tapped into before by any prior federal community development program. And that incentive, that sort of pool of capital that feeds into this incentive, is capital gains generated by high net worth individuals all over the US. And the pool that we're talking about theoretically is like $6.1 trillion, so it's just absurd. Is this a $6.1 trillion program? No, absolutely not. And don't let anyone tell you that it is. What we've seen so far on the capital raise side of this program since its inception, really, and as we'll talk about, kind of October 2018 on, we've probably seen about 10 to 15 billion raised in this space so far. Which, when you think about new markets tax credits, $3.5 billion a year program, this is like 5 times the size, the next closest thing, and it's its first year in operation. So, I mean, is this, the greatest economic development tool of all time? Largest potential? I think the numbers are already starting to bear that out. And the question is really kind of where it goes from here. So, kind of from there, the obvious next step is what the heck is this thing and where did it come from, right? And I think this graph tees up sort of the conversation around where this incentive came from. And this is a graph I think that many of you in this room are intimately familiar with because you live in these places and you work in these places. And that is that since the Great Recession of 2007, not all communities have recovered. And in fact, if you look at the bottom 20% of US communities, heck, even the bottom 40% of US communities, not just have we not recovered, we haven't even gotten back to zero. Those of us that work in these most distressed zip codes in the US are looking at places that have lost jobs, lost productivity, lost economic development every year since the Great Recession. And so the question I think in policymakers' minds was, what do we do about this? How do we create a fix for this? And obviously one of the issues, there are many issues that we confront on our day-to-day, in day-to-day interactions with low-income places. One of the many is access to capital, and that's potentially a solvable one. And so the solution came from kind of a bizarre, interesting place that you would not expect. And that is, this is going to be another fun raise your hands test here. How many of you will either know what it is or will admit to using Napster back in the day? All right, we got like 3 millennials in the room. Okay, 4, there we go. More of you should be raising your hands, I know it. Old file sharing service. It was one of the early Silicon Valley tech companies. The founder of that company, Sean Parker, is a big Silicon Valley entrepreneur type. Many of you probably know him better as one of the first CEOs of Facebook. He's a sort of legendary Silicon Valley investor. He also has a problem, very different than this one, and that is he invested too well in too many early stage companies. So, he'd be in for $5 a share, 5 years later that company's got a valuation of $10,000 a share. And he didn't want to exit his positions because if he did, he'd be paying massive capital gains taxes on all that money that theoretically made as these companies appreciated. So, he looks at this graph and says, I wonder if my problem and this problem could get together and have a solution. And thus Opportunity Zones was born. Literally, that's how it happened. It came out of a think tank called the Economic Innovation Group. You saw that slide. You saw that, the name of one of the co-founders of that think tank on the first slide. They introduced a bill in conjunction with Cory Booker and Tim Scott back in February of 2017, the Investing in Opportunity Act, that became law as a part of the Tax Cuts and Jobs Act of 2017. So interestingly, this is, of all the pieces of quote-unquote Trump tax reform, this was one of the ones that this was around before and got added in. This was not a core part of the original legislation. So this was one of the few truly bipartisan things that got put in the Tax Cuts and Jobs Act, which is a good starting point for a program. Came law in 2017. In March, the law required every governor around the U.S. to select their opportunity zones. That got finished up effectively by May when Treasury designated the zones, but we didn't really have a program until October of this last year, about almost a year ago today, actually, when Treasury released guidance on how to actually use this program, how to make investments on the real estate side. That, on October 2018, gave us a clear pathway from gain dollar into real estate investment. Where this program ultimately is headed, and where I think a lot of you in the room are curious, is to how this incentive can be used to support not just real estate development, but the companies that occupy that real estate development, operating companies, businesses in your communities. And that didn't come until April. That was the guidance we got in April. But at this point, we have a program. I mean, again, like I said, we've already seen substantial investment through it. We're already seeing funds get created. We've seen 8 or 9 deals already get done that we've touched in Alabama. And so the question is just sort of where it goes from here. So lots of usage, and I think usage is only going to increase as time goes along. This is, for those of you curious, every governor had to pick up to 25% of their eligible low-income places as opportunity zones. Okay, so what does that mean? Kendra mentioned earlier new markets tax credits and the eligible areas there. So same set, right? Alabama's a very poor state, frankly, so 60% of the state was eligible for a designation. Unfortunately, Governor Ivey, she could not pick more than 25%. There had to be winners and losers in this process. So politically, one went to every county. She didn't need to do that. I think politically it was the decision she made. And from there, they got scattered to, I don't know, obviously I wasn't in the room when the zones got picked, but having done this now for a year and seeing a lot of these across the state, I think the common denominator of where the rest went was where there is a combination of need but also potential for third-party investment, because that is what drives this program, right? Unlike the programs Kendra was telling you about earlier, new markets, historic tax credits, this is not a program that just happens because there is a building that occurred, because there is the potential for a development. This is a program where unless there is some kind of a return to a third-party investor, there is no real incentive for getting a deal, right? So that was, I think, the metric she used. So for example, lots of industrial sites, lots of interstate exits, lots of downtown areas, right? If you look across the state, because those are places where you're more likely to encounter investable assets. So with that said, and actually, frankly, Troy is a good example of that. If you look where the zone is here, it includes this. I think it starts one block this way, and then goes all the way, wraps around Troy's campus, picks up a part of the bypass, then comes back into downtown. That's kind of typical of zones across the state. So. All right, y'all, it's 11 o'clock on a Tuesday morning, And y'all want to talk about tax law, right? We're excited about this. We're excited about this. Please don't run away. It's going to be fine. I promise you, everything is good. All right, tax benefits of this program. They're twofold. And I'll pull the first piece up so that we can talk about that, and then we can talk about kind of the second piece. So, first piece of this program, tax incentive wise. Let's say that I'm Jim. And let's use a little bit of a different example. I talked about how you can sell off your Amazon stock, or you can sell off your Facebook stock, but there's a lot of things that generate a capital gain event, things you might not think about. Selling off a house, selling off a business, for example, or cutting timber. So let's say I'm a timber farmer, Jim. I cut some timber, generate a capital gain event. Okay. So you see my timber field for $200,000, sold it for 1.2 million. So I made $1 million on my timber crop this year. So I take my $1 million and I put it into the Jim Opportunity Fund. So most of the time, you see high net worth folks create their own funds. You don't necessarily need to go to some third party on Wall Street to do this for you. It's relatively easy to do yourself. So Jim creates his own Jim fund. Decides, there is a really awesome building about 3 blocks that way that's in desperate need of revitalization. Put my $1 million into that building, and I get 2 things in exchange. One, not paying capital gains tax on the $1 million I put into the fund for a while. I will ultimately have to pay it on December 31st, 2026. So I get a deferral of capital gains tax, and I get a reduction in the amount I have to pay. That reduction will either be 15% if I get my money in before the end of this year, or it'll be 10% if I miss that window and get it in sometime before 2021. Okay? So I'm getting a deferral, and I'm getting a discount when I pay my tax bill. Those things are nice, but they're not like earth-shatteringly nice. The really interesting piece of this program is the back half of the incentive, right? So this is all on the front end, on the $1 million I put into the fund. And I have to pay tax on this, but the question is, what happens if my investment, my $1 million, was invested well and makes money? Which again is the goal of this private market-driven incentive. Okay, well, let's say that, I make, clickers, oh no, screwed up here we go. So, let's say that I wind up investing really well, and that the right side of the tracks in Troy, 10 years down the road, is a just awesome, booming, thriving place, even more so than it already is now. And my $1 million I put in is now worth $3 million. My building's substantially appreciated in value. Well, when I cash out of that building, I'm not paying any capital gains tax at all on the $2 million I made on that investment over the course of that 10-year period. That's the really big deal of this program. And double down on that for a sec. Now imagine instead of investing my $1 million into a real estate development, let's say I invested it into the next Facebook, which happens to be headquartered, just off campus at Troy University, right? Some awesome new student idea that, they move off campus, start their company and locate it there. Well, guess what? When that company sells 10 years down the road to Microsoft or Google for $100 million, I'm not paying capital gains taxes on the $999 million I made on that investment, right? That is what's nuts about this program, and where we think the really strong potential lies in the future for growth. There's also, on the flip side, no floor associated with this program. And this is really important for the people in this room. We actually, literally the question was asked earlier, what happens if you're investing in a property that doesn't appreciate, that loses value over time, right? And I think that's a lot of the investments that we make, that doesn't happen. So as a result, is this a market structure that can work with that kind of a project? Potentially, if you massage it just right, but on the facts of the incentive, it's certainly not what if I was a rational investor, the first thing that I'd be looking at, right? Because if I'm a rational investor, the first thing I'm looking at is what's the thing that I can invest, the least in, that will turn over, that will yield the highest, back end benefit to. There is a secondary benefit of this program, and for the sophisticated developers in the room, you will know what I'm talking about when I say that depreciation matters, and that depreciation benefits are pretty powerful to developers. The other benefit of this program that doesn't get talked about that much, but that I think is at least important to throw out there, is that when you exit a project 10 years down the road, normally you're having to pay back some of that depreciation you took over a 10-year period. With this program, you don't have to do that, okay? So for those deals where you're probably gonna sell it at some degree of a loss, you've at least got to take a pretty substantial chunk of depreciation over that 10-year period that you're not having to pay back. So there is at least some minimal incentive for you, even if you're not selling something at a big markup 10 years down But that's kind of the initial stack of incentives for an investor. Now, did you hear me once say that like the developer gets any benefit from this program? No, right? And that's what's crazy about this. This is an incentive for an investor, not for the developer, not for the project sponsor. Unless you got your own capital gains to invest in the project, in which case, great, you're the investor, right? So this is a tool that, back to what we said earlier, provides you with access to capital. That is the goal of this tool, right? It is not a direct subsidy to a project. It is not a grant. It is not a loan. It is an access to capital tool for you to do that. So, what kinds of stuff actually works with this? Yeah. Oh, and by the way, I should have said, can y'all please do exactly what you just did, sir, and like ask me questions all the way through? I really want to make this conversational and not just me rambling up here for like an hour. That would be terrible. Please.
My question, your illustration was playing $2 billion total, like $200,000 total between the two. So the amount that goes into the opportunity zone, is that the capital gains tax you owe, or is it the investment total of your investment? $1 million, in this case, you can only owe what, $250,000 tax?
Correct. So yeah, great question. Question was, for those who didn't hear, what do you actually, like, what do you put into one of these funds? And the answer is, it's the gain from a sale. So if, in this example, I've got $200,000 in basis and $1 million in gain, right? So I'm putting in the gain. I'm not putting in the basis. And I can put in as much of the gain as I want. I can put in the full $1 million that I made. I can put in half the $1 million that I made. But if I put in half, I'm paying tax on one half and not paying tax on the other, right? Simple as that.
So it's the gain, not tax liability.
Correct, it's gain, not tax liability, and not full amount like you have to do for 1031, right? Cool, yeah?
Can the capital gain come from real estate?
Oh yeah, it can come from, I mean, the big buckets of gain, real estate sales, stock sales, sales of businesses, so you sold your paving company you've owned for 30 years, you've seen a couple of those. Cutting timber, a few other categories. If any of you have a coin collection, by the way, you can sell that and make some money and use it for this. Just FYI, found out. No coin collectors in the audience, that's fair enough. Okay. Any other, yeah. So in other words, like you're getting just income out of it. Like you have a business, it's profitable, it's making money back to you, and you're wondering if I can invest that money into this. And so, not normally. Depends on how the business is structured, but typically, especially if you're a sole proprietorship or just a limited partnership, normally like those distributions you get out of your business are just income to you, ordinary income to you. And this is a critical point. If you have ordinary income, wonderful for you, I'm excited. This has nothing to do with you. You have to have capital gains to participate in an OZ vehicle and get these tax benefits, any of them, including the back end benefit, okay? So ordinary income is great, but it doesn't really help that much. The only exception to that rule is if you're getting distributions, if you're getting dividend distributions, if you get a C Corp and dividend distributions, then maybe it works, but maybe we should talk about that later.
I had a question
Yeah.
on the actual opportunity zone, say for the city of Troy.
Yeah.
You described it as being from one block here out to 231 and coming back around the university. Will someone go into more specific details exactly where it's located at here, or?
Tell you what, at the end of this presentation, if I can get a little bit of technical help, I will pull up the whole map and we can like zoom in and we can play with it a little bit.
Okay.
Remind me to do that.
Thank you.
Okay. Cool. Yeah.
Just to, your GIS mapping department with the county, Pike County should have all the opportunity zones already laid out based upon county commission districts. So if you just ask them, I found that to be the case in Montgomery.
Yeah.
GIS mapping department has all the opportunity zones for each county commission district, and just print the map out to see how that's laid out.
Thank you.
And I will also suggest, so there's a good mobile version of this map on both our website, opportunityalabama.com, and on ADECO's website. So I will assume if any of you are looking at your phones for the rest of the presentation, I'm sure you're looking at the map of the OZs in your local area, which is totally fine with me.
One more question.
Yeah, what's up?
The 15% reduction of real property gain tax
Yep.
after 7 years.
Yep.
Is that the maximum? If you every other 10 years, do you get any further deduction in the original capital gain?
Nope. Yeah, so really good question. So that was like, how does this initial capital gains thing work? Remember that for whatever reason, Congress said everyone in this program must pay their capital gains taxes on December 31st, 2026, period, end of story. So the only reason, so in other words, if I'm in before the end of this year, I will have been in for 7 years before 2026. That's why I get that 15% discount, right? And that's probably not gonna change. Cool. All right, let's keep rolling, because we got a whole bunch of other fun stuff to talk through. So what kinds of projects are we seeing it get used for? So these are the big asset classes that I would say you see OZ projects get done, sort of get done consistently. I like walking around and something through this. Projects that we see get done, we see real estate, we see operating companies, the two big buckets that you saw from before. The subcategories, the ones you think, it's workforce housing within residential. I would say that's probably the number one asset class you've seen get done across the state right now is workforce housing. 80 to 120% of area median income is normally what we see get done there. On the industrial side, build-to-suit deals. On the commercial side, it's anything. It's hotels, it's downtown commercial, it's interstate-based commercial. It's kind of whatever you've got in your community. There's normally some kind of a potential project you can tee up. Downtown revitalization kinds of projects. I will also suggest, I don't have this on this slide, but for this audience in particular, one of the asset classes that we see as a growth asset class, and this is like in the last month, public-private partnerships and or projects where there is sort of a community or university or civic anchor for the facility. And so what do I mean by that? So I mean, let's say that you've got a local college or university that really wants a new workforce training center, or you've got a city that really wants a new workforce training center or business incubator space or something like that. And they're willing to want that enough to sign a 10-year lease, right? Or to backstop a 10-year lease with someone else in that building. Well, if that's the case, then all of a sudden I've got a marketable OZ deal. Because I know that even though, maybe they're not willing to pay an exorbitant lease rate, maybe they're not willing to pay me a lease rate that yields me a 12% return on my investment, but they'll pay enough that if I can stack all the tax credits Kenji was talking about earlier, the new markets tax credits, the historic tax credits, the other tax credits on top of that baseline lease payment, I can generate enough of a return on a smaller amount of equity to actually get a deal done. We've seen a couple of those get done across the state. And a lot of the interest in that has been from local folks who just have a capital gain event and want to be kind of a local investor, want to be able to help their community. The other half of that interest comes from these groups called impact-oriented funds that we'll talk about in a minute.
Question.
Yeah.
So what if, this type of project, want to be developed in a non-opportunity zone? How does this work? I mean, because you're saying that only the governor gave 25% to areas that were pre-selected, but there may be other areas who have potential to use this formula for development. What happens then? Do they qualify for this type of package?
I will answer your question on the condition you promise not to walk out afterwards. Yeah, all varies a little. Because the problem is, and again, this is what every governor had to face. I mean, look, the statute said pick 25% of the places that are eligible, right? So 3/4 of the places in Alabama that could have been aren't. And there's nothing we can do about that, because that was the
Is that
ceiling.
locked in now?
Yeah.
Those that designate are the only ones that the rest can be included?
There may be some zone realignment that happens, 4 or 5 years from now down the road, but it would literally take an act of Congress to change the zones at this point. That's where we are. Yeah.
I heard something about if a community or an area was directly adjacent to an opportunity zone, they may qualify. Is that true?
Thank you for asking that. No, it's not. I hate that because a lot of people have heard that. That was as part of the zone selection process. There was this adjacent, but after the zone selection was done. Now here's the one exception. Okay, so I will give you a glimmer of hope. Okay, and that is, and we're actually seeing this work in a couple places. There's a project we're working on right now that actually is leveraging this particular caveat to do a project that is not in the zone. And that is, we'll throw the rules up here in a second, but there's kind of this little bucket that we have available to us that says, look, as long as you're doing enough stuff in the zone, if it's all part of one project, some of it can be outside the zone. So that's the caveat that we're giving, and we'll explore that in detail here in a minute. Yeah.
I did a little reading on that, but those zones are based on census reports, that the government did, correct?
Correct. So all the opportunity zones are based on census tracts. That's right. Yeah. So that was kind of that first slide. I was talking through. There were 60% of the state was eligible. She had to pick 15. She had to pick 25% of that. So we have the ones we have. They're also based on census data. That's correct. On the operating company side, the one thing that I'll mention on operating companies, obviously manufacturers, industrial folks, like easy to qualify because those are growth companies. I would ask you with a straight face, do you think that your local coffee shop is going to be worth more 10 years down the road than it is today? Right? Answer is probably not. Right? So as you're thinking about kind of what kinds of operating companies could attract OZ capital, that is the sort of litmus test you have to use. Is this a company that will be around 10 years from now and be worth more 10 years from now? So with that said, this is what I promised you. This is a lot of words on a slide. So why don't I just tell you what this says and get into my kind of the bucket that I mentioned from earlier, right? So here's what this slide says. It says that at the end of the day, every one of these projects will need an investor, that's the top, a fund, qualified opportunity fund in the middle, and then a project at the bottom, okay? So, you need to find all three if you're gonna get one of these deals done. Or at least you need two. At least you need the investor and the project, right? Because they can make their own fund. So, all of you in this room, I think, will be the bottom. Like, all of you will want to figure out whether you have qualified projects locally. And so this set of rules I'm about to tell you is what determines whether you have a qualified project locally. And there are three things you gotta think about, okay? One is when the asset was bought. So is this an asset that was acquired after 2017? If the answer is yes, great, move on. Two, is it in the zone? Check the map, that's all you gotta do. Okay, so substantially all the project has to be in the zone. Third, the project either needs to be new construction or it needs to be a substantial rehab of an existing building. Policy rationale here is, look, we don't want someone just coming into a low-income place, buying a building, putting a coat of paint on it, and calling it a day, right? We want to actually see real investment. So, if I buy a building, real numbers, let's say I'm Joe, had my $1 million of gain, great. So I find that building across the tracks, I buy it for, let's say, I buy the whole thing for $1.5 million. The building is worth $1 million, the land's worth $500,000. Okay? I will then go get a loan for $1 million to go improve that project because I need to put at least what I spent on the building into the project in order for it to be a qualified project. Knowing that building, knowing most buildings in Alabama, it will take a lot more than just what I spent on it to actually improve it, right? So normally most of the projects we work on, the real rehabs we work on normally need this test. The other option is just build something new out of the ground. Anything new out of the ground counts every time. So you can build a shack and that's a qualified OZ project. Simple as that. The rest of these rules really relate to sort of how you as a business qualify for this incentive. So as a business, weirdly enough, you still have to meet those same tests around, are my assets in the zone? Are they new assets acquired after 2017? And are they sort of original to the zone? Are they new assets in the zone? But you also have to meet another test. And that says, that relates to, I know it says up here, active conduct in the zone. What that means, Treasury told us, half your employees need to be doing their work in the zone. If half your employees are doing their work in the zone, then you are a qualified business. There are some exceptions to that. I mean, that's the basic rule. And if you don't meet that test, there's actually even a fallback that you can still meet. So if you've got a zone, if you've got a business that has its headquarters in the zone, about 80% of the time you should be just fine, and you should have a qualified company. Okay? So that's kind of the way that these stack up. To your question from earlier about how I can do projects that are adjacent to a zone or outside of a zone, here is the answer. All of those things I told you about how the property needs to qualify. So, the fact that it's got to be bought after 2017 from an unrelated party, the fact that it's got to be in the zone, the fact that it's got to be substantially improved. All of those are subject to effectively a 70% bucket. So, only 70% of my project needs to meet those standards. The other 30% of my project can be literally whatever, right? It could be a building in Aspen. Please don't let it be a building in Aspen, but like it could be a building in Aspen, right? It could be, just a random other asset, another business you acquire. It could be literally anything else. So there's a couple projects we're working on now where they sort of, the project, there's critical mass inside of a zone, and then there's another project that's really interesting that's sort of outside the zone. And so we're bundling all those under one general business. That all then feeds up into the fund, and because 70% of the actual stuff is qualified, it works. So it's just a math test. It's literally all it is. It's measure up the assets in the zone versus the assets not in the zone. Yeah.
Okay, I'm just trying to make sure I'm understanding it correctly. Okay, I get the bill, I buy a building in the zone, I started selling a grocery store.
Yep.
Storage warehouse in another zone that's not in that area.
Correct.
Okay.
So theoretically, yes. So let me put numbers around that. So the example was building a grocery store in the zone, and then I've got a storage facility not in the zone, right? For my grocery store. That all works as one project if the grocery store is $7 million and the storage facility $3 million. That works. Okay? So it's just a math exercise, literally. Great. Well, that was a lot easier than normally the slide goes. I'm glad y'all just get this stuff. This is my cheat sheet, by the way. So if you're wondering, all those words in the last slide all boils down to this. 1, are you in the zone? 2, is it either original use or is it substantially improved? 3, is the thing investable? Because that is the #1 question you're gonna have to answer from investors. Will this thing make money over a 10-year period, right? And I'll send this deck to you later on. So you can have this kind of cheat sheet. Same on the operating company side. It's literally just like, look, at the end of the day, half your employee, or at least half your assets in the zone, or at least were your assets sort of bought after December 31st, 2017, and then do half your employees work in the zone. This is the sort of cheat sheet for qualification. Yeah.
I know you mentioned new construction and rehabs.
Yep.
You want to also mention dilapidated properties, tearing those down, or overgrown vacant lots could also qualify.
Well, thank you, Dr. Hood. And y'all should you will hear from Dr. Hood later on today. There is at least one group in Alabama that's taking advantage of a really interesting provision of this incentive that says, at the end of the day, if the property that you're working on has been vacant for 5 years or more, even if there is a structure on it, it is treated like it is a original use ground up construction, okay? So in other words, if you buy a vacant, dilapidated building for $500,000 and it's been vacant for 5 years or more, you could put $10 of work into it and it's still a qualified project. So that's been a really interesting. Now, please don't put $10. Put some actual work into these things, guys, please. But that would still be a qualified project, and it gives you some more flexibility. Cool. So, all right, last thing. This is the last tax law slide, guys. We're almost there. But there are some timing considerations I want y'all to think about as you think about this program. And this is more driven on the investor side. So get through this and then we'll talk about practical application. But on the investor side, there are a couple of time hurdles you need to know about. 1, from the time that I have a gain event until the time I've got to go invest in a fund, I have 6 months. And that is all, okay? So this is not something where I sold my company 3 years ago, can I take advantage of this? No, okay? It's got to be within the last 6 months when the gain event happened. And there's some exceptions to that, but they're not a lot. Okay, that's 1. 2, once I make my fund, and that's this thing in the middle, I then have between 6 and 12 months to get the money from the fund down to whatever project y'all in this room are working on. So if you do the math on that, I basically have between a year and a year and a half from the time a gain event happens to the time that gain event needs to be invested in my project. So that is something to bear in mind when you're talking to investors about this or people in your community about this, is that this is not a forever thing. But it can provide you with some really interesting motivation to go talk to people because there is a time clock on this. And we've seen this time clock be very helpful if you're trying to start a community conversation around what reinvesting locally looks like. Having this clock can actually kind of help sometimes. Otherwise, I would say the only other thing to note about this slide is that it is really, really easy to start a fund. I mentioned this before, but I want to reiterate this point. If you've got someone locally that says, oh yeah, man, I would love to support the work that you're doing, whatever that project is, affordable housing development, grocery store, the things that have been mentioned so far. I would love to figure out a way to support that work. And it's same local folks that, again, cut timber, have gains, want to figure out a way to reinvest in their community. It's literally one call to a lawyer, one call to an accountant, and you can set up a fund. And they're pretty cheap to set up. I mean, we've seen one get done for a $150,000 project. So, I mean, there's no real cost scale to this. Cool. All right, y'all can all breathe. We're done with the tax law stuff. Let's talk about what's actually getting done around the state. So, these are the people. I think this is this one's an interesting slide because at the end of the day, it kind of shows you who is doing these deals. And I would say there's 4 groups. So this is, when you're orienting yourself to this program, because it's investor driven, you need to know who you're talking to and who you're developing marketing materials for. These are the 4 groups. And I would think about, depending on the project you have, which of these 4 groups are most likely to be your ideal target investors, okay? So, group 1, local folks. And these don't, obviously this is like a generalization. They can be in New York right now. They can be your prodigal sons and daughters that have gone away to college and done well for themselves, but still have a heart for, wherever you're from locally, right? For wherever in the Wiregrass. And we've seen some really interesting deals get done sort of on those lines. So who are those people? What you need to be thinking about coming away from this conversation is, who are those people locally, whether they live there or whether they've moved away, and what kinds of things could you put in front of them that would be interesting to them from a community development perspective, okay? So that's part 1, and it will make money, which is the second piece. Part 2, impact-oriented investors. These are folks that you may never have heard of. In fact, I would guess many of you have not heard of before. So these are folks that have been investing in like third world countries for a very long time. They go to these big international conferences, and all of a sudden this incentive has made them realize, holy cow, there's a lot of need here domestically too. And let's think about how we can build a real estate investment strategy around transforming placemaking low-income places, right? So these guys are willing to provide slightly lower cost of capital for getting projects done. So they're a great group to have in your corner. And these are the folks, the reason I said we've seen a lot more of those P3 kinds of deals get done, rural broadband kinds of deals get done, it's because of this group, because they're willing to put capital on the line to do those kinds of deals. The third group that we're seeing get in this space are, I will call them your opportunistic investors. So I would say that like you actually are going to hear from a great group of investors who sort of have this philosophy here in the room today. So it's folks that they're developers typically, and they're looking for places in your communities around the state, around the U.S., where there is a strong need and there is a strong impact to the project, but there is also the potential, if you do the project just right, for there to be enough of a return to actually get excited about, right? And those deals exist if you can do the capital stack in just the right way. So that for this group, it's a question of, do you have that asset that if you find just the right use case for it, could produce a pretty strong cash flow, and that would also be community oriented enough to attract a strong layer of tax incentives, new markets tax credits, historic tax credits, and other tax credits. That's normally, a lot of the time it looks like an old school, it looks like an old abandoned hotel building, things like that, right? Where there is a really strong use case, like a senior care facility, like a new hotel, a new strong flag occupant hotel, a really strong, branded grocery store, something like that could anchor the facility, right? So that's the next piece. And then the last piece is, this is the group that, the tax benefit oriented investors, this is like the Goldman Sachs investors, right? These are the guys who, believe it or not, they're looking at a lot of projects in Alabama, but 95% of them are in Birmingham and Huntsville, right? It is hard to get these folks out of the major markets. We're working on it, but we are not there yet. So we'll see. But the rest I think are really interesting. So stuff that's gotten done so far, just give you some practical examples of the kinds of projects that we're seeing. Workforce housing, I talked about this as an asset class earlier. American Life Building is a good example of these kinds of projects. $24 million project producing a bunch of new units of workforce housing in Birmingham. It's got, the reason this project got done was because an impact-oriented fund, namely PNC Bank, which has its own captive opportunity fund, said, we love the impact story of this project and we're gonna put up both the equity and the debt to get the deal done. So it was a great, kind of a good example of both workforce and actually some space for prison reentry too, with the Dannon project. You're gonna hear all about this one later, so I'm just gonna skip over this one for now. But trust me, they're awesome. Other examples that we heard about. So these are a couple of unique ones that I'd highlight for you. In Tuscaloosa, Stillman College is using OZ incentive. There's actually a fund called the Renaissance HBCU Fund that is specifically focused on investing in HBCUs and on campus edge HBCU projects. Their LP base are people that care about HBCUs. So they're willing to take a little bit more risk and to take a little bit of a lower return threshold for achieving that social objective, that social impact. So they have committed to do a project, both a hotel project and a mixed-use retail project right there on Stillman's campus using a ground lease arrangement with Stillman. So that's a fun deal that we're anticipating getting teed up Q2 of next year. The last example, this is going to be a fun one for a lot of you in the room. So this is in Birmingham. How many of y'all been to Woodlawn in the room in Birmingham? Okay, a couple of you guys. So so Woodlawn is, a lot of you have seen kind of stories about downtown Birmingham and the Renaissance. A lot of things are happening in downtown Birmingham. That is true. Things are starting to happen in Woodlawn. It's about 3 neighborhoods removed from downtown. So Woodlawn is the kind of place where, there could be potential for gentrification down the road, but it's not really there yet. There's a local nonprofit that teaches music classes in Woodlawn, and they've been paying rent in just a building there for a very long time. They went to their donors and said, look guys, how about instead of just giving us rent money like we've asked you for every year, instead, we just all find a building together. And I present value how much I'm gonna ask you for in rent over the next 10 years and just ask you for a check today. And we'll all go do this as an OZ deal. And it worked. Their donors ran the numbers and said, yeah, we've all got capital gains. And actually, if you look at the math on this, it is better for us just to give you a big check now, do this as an OZ investment, and just own a building together in Woodlawn, and let you live rent-free in this thing for the next 10 years. So half it's going to be space for a nonprofit music studio, the other half it's going to be space for a commercial performing arts venue, and that provides enough cash flow to keep the investors happy for a 10-year period. So it's a neat little deal structure, one that involves the nonprofit and the ownership structure. So there's actually potential of this building, if Woodlawn does turn a corner, and hopefully, there is some degree of community improvement without a whole lot of displacement, as is our hope. That down the road, if this building gets sold for $5 million, that the nonprofit will make a tidy little sum and have its own money to go buy its own building down the road, completely, without even the need for its donors to get involved. So, really interesting deal structure on that one, and it was a $150,000 fund. So again, the point is you can do these as small dollar value deals too. So that is kind of what we're seeing in the marketplace right now, and we've got a little bit of time. So any thoughts or questions before I kind of jump into how we're seeing this get used in communities as an organizing principle?
Just a quick question.
Yeah.
The project in Woodlawn, what's the name of the nonprofits involved with that?
So it's Mason Music's Foundation.
Okay.
Yeah. Yeah.
I'm an optimist, but I'm a realist as well.
Yeah.
I see in 2017 when this tax incentive came about, and it goes to 2026, correct?
Correct.
There's an opportunity for the have and have not.
What do you mean?
Well, capital gain, you talk about $2 to $3 million, when you look at the scope and narrow it down to how many people would fall in that category and have that amount of money invested over a 10-year period. You talk about a very small group.
Yep, you're right. So, and that's what's interesting about these deal structures, and that's why I love the Woodlawn music example, and why so one of the things that this will be a whole subject panel later on down the road, is how we leverage this incentive to both create development in low-income places, and then also ensure that there is wealth building that occurs in the low-income places where the development is happening. And you are exactly right. And this is, I will just tee this, I'm gonna lay this one out perfectly for the panel at one, because this is one of the hottest subject matters for debate within the OZ landscape. There is no requirement at the end of the day for any OZ fund to include any community organization or benefit or nothing like that, right? Not like new markets. So it is on the fund sponsor, it is on the investor and the project developer, I mean collectively the deal team, to ensure that there is some level of community input that goes into the process. And then community ownership at either the 10-year exit or during the life cycle of the investment. And yeah, we've got plenty of templates for that, but it takes willing participants to make it work.
When I think of OZ, I think of the Wizard of Oz. I'm the lion, I need more courage, I gotta figure out a way to make this happen.
Yeah, no, it's, I'm with you. Go ahead.
Have you seen a scenario, or has it been discussed, of a philanthropist, investing money in, say, a public-private partnership, and that public-private partnership is able to take advantage of the 10-year tax shelter
Phenomenal
to
question.
benefit the community?
Yep, no, phenomenal question. And in fact, as we think about the role for local community foundations to play in this space, and in fact, I tell you what, yes, and remind me to answer your question in 2 slides, because I've got them up on this slide, and I don't want to talk about it, but I'm going to today.
We have a scenario like that in Northwest Florida, I'd like to talk to you about.
Okay, yeah, no, and let's actually talk about it in front of the room, because I think this is one where I'd love to see more foundations get involved in this space. Yep, yep.
I guess I'm raising a red flag as this is being a red line, because you have investors that are not really interested in investing in communities that really need this type of economic boost. Then you see dilapidation becoming lopsided. How do we meet that challenge? How do we deal with that? Because, you know, I see, you know, if you got investors, they're always looking for attractive type of areas that have a potential economic growth versus those dilapidated areas that don't have the revenue, and yet this is dancing his diamond out of reach. How do we approach this? You know, how do we move toward making it a reality? So that there's an opportunity zone that's not really targeted where opportunities should be focused, and how do we move in that direction?
It is, so these 3 questions all need to be answered simultaneously, which I'm gonna pull up a diagram on this next slide that I think will help you see that. Yep. In fact, let me just go ahead and go on that, because I do think this is important. So, to your exact point, look, at the end of the day, when we're talking about trying to get capital for projects in Alabama, this is what we're up against. There's literally a zone down the street from Stanford's campus in Palo Alto. There's one across the mountain from Bethel. So like, I mean, you know, we're all talking about how we get money to Troy and Selma and places in the Black Belt and Wiregrass and like, let alone Birmingham, right? And this is what we're up against. So how do we do it? To your question, how the heck does this actually work? And to us, the only way to think about this is to think about OZ investment as a comprehensive ecosystem, where the OZ equity is but one piece of the broader capital stack, to the point from earlier, that it's deployed strategically towards projects where there is a gap and that gap can be filled by an investor, and where you're building projects consistently with a bunch of stakeholders in the area that can actually get done. And so who are those stakeholders, and what can this program be used for more broadly? Because at the end of the day, what I'm about to show you is the roadmap that all of you know and probably have already invented in your local community to what community development looks like. And what's been fun is that over the course of the last year, we've been able to use OZs as an excuse to start this conversation about what a local investing ecosystem looks like, regardless of whether the investment ultimately happens in a zone or in a property 2 feet outside of the zone, or whether someone's investing with capital gains dollars or non-capital gains dollars. The same people need to be at the table having this conversation regardless, right? So this is kind of the model that we've been using in cities across the state for building an opportunity zones ecosystem. And that is 4 groups: communities, and that's y'all in the room, plus elected officials, local economic developers, chambers of commerce, people that kind of have the public sector's interest at heart, project sponsors, that's, again, y'all, plus local developers, plus local landowners, plus local business owners, plus local existing industry entrepreneurs and others who could have potential OZ investment opportunities. Third are the 4 groups of investors I talked about on the previous slide. And for us in this room, it's almost exclusively focused on the first 3. The local folks, the impact folks, and the opportunities, right? And then the opportunistic investors. And then finally, this is the key, it's the institutional partners that can come to the table to help get this whole ecosystem put into place. Namely, banks who can make debt, who can do debt deals, right? It's people like Hope who can provide stacked financing and get deals done even if there's not OZ equity at the table for whatever given reason, right? It's local utilities who can be super helpful in, everything about the project development process, but certainly in seeding this effort. It's local foundations. How can local foundations be helpful? Well, exactly to the point from earlier, right? Having a community foundation that's willing to make what are called program or mission-related investments. In other words, taking a piece of their corpus and saying, look, we're not going to make you a grant. We're not going to make you we're not just going to cut you a check out of that 5% we have to give away every year. We're going to take part of the 95% that's in our bank account and make you a loan or an equity investment into this project at a very preferential rate of return, right? Like at a no interest or a 1% interest over a 5-year period with a balloon payment, stuff like that. So we're seeing more interest across the state. Certainly nationally, a lot of the impact investors we're talking to are exactly that. They are foundations who want to help with these projects. Locally, that's happening more and more. And I would encourage you to talk to your local community foundations and ask us if there is anything that we can do to be helpful in those conversations. We have seen models of this work, right? So community foundations getting engaged, providing low-cost capital to make a deal work where otherwise there wouldn't be enough return profile for a deal to work, right? Universities, who could be super helpful. Look, at the end of the day, these projects, if I'm going to go realistically put an investment opportunity in front of someone who I'm trying to part them with their hard-earned money, I need to have a good investment thesis around that project. I need to have buttoned-up financials, a buttoned-up 10-year pro forma, a demand study showing why this grocery store is actually going to work, or this child care facility is actually going to work, right? All those things, environmental space ones, all those things, right? Well, who's in a unique position to actually provide the brain power to do a lot of that stuff locally and who might not charge you an arm and a leg for it? Local colleges and universities, right? 2-year or 4-year that have students and professors who, have been engaged in this stuff locally and nationally. Dr. Hood being an excellent example of that. Attorneys, accountants because, actually both groups, because look, at the end of the day, if you want to know where the money is in the community that you don't necessarily know about right now, go talk to your local accountant because they do. And they can be very helpful in this process if you buy them enough cups of coffee or drinks or whatever you want to buy them. And that's it. It's using your network of partners who might not have a project, might not have gains, but that can be helpful to you in teeing up this broader network of folks. And once you've done that, or sort of as you're doing that, this is where we want to help. So again, to answer your questions about like how we actually leverage this thing, well, staring down the barrel of opportunity zones back in August of 2018, a lot of the sort of core institutional stakeholders across the state, Alabama Power, Regions, Protective, ADECA, said, look, if we don't have a coordinated response strategy for opportunity zones, the only stuff that's going to get done, if anything gets done at all, is the stuff that investors are wanting to invest in anyway. It's the stuff that will produce the highest levels of return in the places that maybe not, don't need this. So the question was how we leverage this incentive effectively for the people in the room. That's why we created Opportunity Alabama. So we are a nationally unique 501c3 that specifically exists to help be the sort of the standing point clearinghouse for all things opportunity zones across the state, with an explicit mission of being sort of an economic development engine for our low-income places. So our focus, our mission, our vision is using this tool and helping you locally build this network so that you can use opportunity zones as an excuse to start a conversation about what community development should look like in your community. And if at the end of the day, all it does is start that conversation, every one of your deals gets done with Kendra and Hope and new markets, that's great with us. We couldn't care less. Because I think this gives you a unique chance. No other tool would give you an excuse to get these 4 groups together, really ever, right? So that's, I think, the biggest, honestly, the biggest power we've seen so far of this in communities has been it's the convening power of this tool, if you leverage it properly, okay? So that's what we exist to do. It's capacity building, it's working with you to help scale those projects so that you're not having to call your local university, you can just call us, and we've already got people in our network that can help provide some of that pre-development assistance. We're working on marketing materials for both projects and for communities so that places like Troy can go talk to someone from the Bronx and have some level of understanding about why it makes sense to actually invest in Troy. We're working on obviously building a marketplace of introducing all these folks to each other, and then because we're a C3 and we actually believe in this thing working for low-income places, tracking data to see whether the investments that are happening, whether they're in a downtown Birmingham or here, are having social impact, are actually creating jobs for low-income people, are creating better financial inclusion, are creating more green space, more LEED certified buildings, that kind of stuff. So we're one of the few organizations in the US that actually has a statewide comprehensive pipeline of impact tracked projects, which is pretty cool to say that Alabama is one of the first in the country to be doing that. And at the end of the day, we've seen a lot of success. We're working with a bunch of communities all over the state. If we are not working with you yet, come find me afterwards, because that is our mission and we should. Part two, we're working with it's been nuts. I mean, we've got probably 220-ish projects that we're tracking on an Excel file right now. 30, 35 of those are ready, have all their full deal package in place and are actively being marketed in front of investors. Gotten again, like I said, 8 or 9 done, 3 or 4 more in the pipeline to get done before the end of the year. So it's moving. The train's left the station, we're on the tracks, and we would love for as many of you to hop on as is possible as we continue to roll on forward. And like I said, obviously the only reason this works is because we've sort of built that network of national investors. And what we really need from y'all in the room is projects, and it's access to these bottom two. It's the local institutional partners, and it's the local investors. If you can bring those two, if we can figure out collectively how to bring those two groups to the table, then this can be a reality for y'all locally. But that's the question: is projects, what works, stuff that actually works, then working through and that's a detailed pro forma level analysis of what's going to work and what's not. But we're more than willing to have that conversation with you, and then local folks. Who can we get engaged? So that's the process, and that's what we've been doing across the state. And this is, I would say, I put this up more for your reference. This is a slide that I like to use kind of in that initial conversation with the community. What are the things you need to do to get quote unquote OZ ready to actually build this out locally? And that's 3 buckets of capacity building. It's convene your local group, so identify a group of local stakeholders who are excited about this, who, maybe it's in a lot of places, it's the local economic developer, the chamber person, and then someone who's grassroots locally, right? It's a small core group. They can then drive the conversation forward. They can work with us on identifying local projects, on building out that local ecosystem list of people that can get engaged with this, and building out initial set of local marketing materials. And that process will wind up uncovering a lot of really interesting projects locally. We'll vet those, put them into our pipeline, do some pre-development work and see if they actually work, and then all meet back in the middle with an ecosystem convening event where we get all those folks in a room and talk about what's available locally and how this incentive works. We do the same kind of conversation we did today. Yeah?
You have this on your website?
This is a special in-person kind of thing. We probably should put this on our website, shouldn't we? Yeah, I'm happy to tell you what. Let me pull up my contact info. This is a brag slide. We've done some really cool stuff. It is actually, I will pause here. It is nuts. Alabama is consistently at this point listed as the national leader in how OZs get done, which is crazy. And which is, honestly, we just started earlier than everyone else. And credit the institutional partners that we have for resourcing that thing to happen. But yeah, y'all in this room can, if we do this right, and we are the only state with this kind of infrastructure. So we need y'all in this room. If we can all work together, we can keep on driving the train. But it will take more of these kind of impactful projects. It will take more examples of good quality impactful projects like the one in Woodlawn to keep the train moving at the speed that we want it to move. Yes?
Are your fingerprints on the Birmingham 24, 27 opportunity zone in one program called?
Oh, are you talking about our sort of, okay, so there is a big initiative like the Birmingham Inclusive Growth Fund, yeah. Okay. So credit the city of Birmingham for the vision and yeah. So any of y'all heard of the Big Fund or Big Initiative? Okay, a couple of you guys. So Birmingham is one of the most, if Alabama gets consistent, Birmingham and Alabama kind of together have been sort of cited as these national examples, and a big part of it is because Birmingham got started just as early as we did. They put together a group of local folks. So they have institutionalized this process I had up on the last slide. They basically said, this whole thing, Birmingham is almost doing within city government. So they've actually put together a core stakeholder group within city government that then mobilized a group of representatives from each of the 7 council districts that has an OZ, trained those people on how to identify OZ projects, and have been having community investment, community meetings and even educational events within communities on what OZs are and how to identify quality local OZ projects. On the other side, they've got an investment advisory board of high net worth local folks who care about the community and who are national and local and want to give back. And the idea is that kind of those two meet in the middle, that project gets serviced on one side, investment gets serviced on the other, and if there's quality enough stuff, it can migrate the gap. So with that said, that is the full thing on OZs. We went through this. A fair warning, I ran out of cards at an event last week, and my new ones come tomorrow. So truly, I hate this. I do not have any business cards. So I would strongly encourage you, this is my contact info. That's actually my cell. Reach out to us. We've got a contact link on our website too, honestly. So.
Say your number out loud.
Yeah, sure. I tell you what, why don't I give you, so number is that's small. 334-425-4166. But honestly, the easier way to get me is email, and that's just alex@opportunityalabama.com. It's pretty easy. Just my first name, alex@opportunityalabama.com. But yeah, that's OZs in a nutshell, and I still have 10 minutes. Huh. And I've already answered all your questions, so I get to run away. This is great.
I got a comment more on this question.
Go for it.
Say I'm looking at what you have here from the capital gain, okay? That would be ideal, but I have 10 friends, and I'm one of those friends. We would have put in $50,000 each.
Yep.
That's $500,000.
Yep.
One is a builder, one is a contractor, the other is a designer, banker, an accountant, a lawyer.
Yep.
We got all the entities we need to really drive this forward. We just need to be able to get into this opportunity.
Yeah, but I mean, look, if you've got all those people and they all have a little gain event, and they could all pull together to form a fund to go do a project.
But it's not capital gain.
Well, so we're not going to be able to use OZ as a vehicle, unfortunately, but still give me a call and we'll figure out what we can do.
I guess we have time maybe to look at that map
Oh,
as
yeah.
an example.
Thank you. See, I was going to totally forget. All right, so I'll pull up the map. I would say for anyone who wants to kind of come up and walk through the map afterwards, I don't want to hold. If you're interested in getting over to lunch a couple minutes early, I don't want to hold you up. Last thing I want to do is stand between you and lunch. But are there any other questions before I pull up the map? We can have a conversation up here. Yeah.
Are you at all in touch with the federal, what is it called, the Revitalization Council?
The White House Council on Revitalization. Yeah. So Scott Turner is a friend. They're working their hardest within the structure they have to make this work in communities. If any of you, I would say we've got Michael here from oh my gosh, I almost said DRA. Wow, that was bad. From the Economic Development Administration, EDA, yeah. The EDA has been a really strong. They've been one of the leaders of the council so far, as has Delta Regional Authority. So yeah, if y'all need anything come on the federal side and want to figure out how federal incentives sort of overlay with OZs, please give us a call. Happy to help. Great. Okay. Last one.
What's the typical? Is there a typical size project, or is it different depending on the city or the nature of the project?
Depends on. So honestly, so the question is on typical size. No. I will say if you want true third-party investors that don't know you from Adam to look at your project, it's probably going to be $1 million or more. And honestly, if it's in a rural area, rural projects are even harder. They're just harder. I mean, even if they're $1 million, it's just hard. And it's hard to get a project over $1 million in a rural area, honestly. So it depends on your investor interest. The Woodlawn project is $150,000. Each investor put in 30 grand. So, I mean, if you got willing investors, it could be 10 grand, 15 grand. Great. Okay, thank y'all so much.
Does this belong to anyone?
That's fine.
Oh, I need one. We are going to break for lunch, but I hope that the information that has been shared with you today really give you a deeper insight and possibilities. You got opportunity zone, but you got hope also. I would say we have a session that is a time set aside for networking. Make yourself available. gain more information, and, let's see what opportunities that are out there for us to be able to tap into, and, let's go for it. Nothing failed but a try sometime, but if you don't try anything, you know you're going to what? Not be successful. Before we break for lunch, let me, we're glad to have Angela Rowley from,